Today, I want to talk about a few of the shadiest tax strategies I came across over the last few months. A client calls me up and tells me he will be making about $500,000 in income in 2026 and wants to deploy any and all strategies to reduce his tax bill. He said he had spoken with various tax strategists and wanted my opinion of the two best strategies that he had been pitched so far. Strategy number one, leveraged charitable contributions. Now, before I jump into the details, will you do me a huge favor? Please hit the like button and subscribe to my channel if you like learning about tax and finance. Thank you in advance. All right, back to the story. So the client tells me that he can donate $50,000 and then take a $200,000 charitable donation deduction. He can't really explain the math and logic, but he said that it really sounded legitimate to him, and the promoter supported it with case law and the tax code. I explained that this does not pass the sniff test. There's zero chance that this would hold up if audited. And if you include a $200,000 charitable contribution on your tax return in a year where you made $500,000, good chance you're getting audited. A version of this I saw frequently sold in 2023 and 2024 was something called a syndicated conservation easement. In 2023, a CPA named Jack Fisher and an attorney named James Sinnott were sentenced to decades in federal prison for running a scam doing exactly this. They told taxpayers that they could invest in undeveloped land for $1 million and then get the land appraised for $10 million. The logic was that this undeveloped land could have been a luxury resort, which would make the land very valuable. They would then donate the development rights to a conservation trust and take a write-off based on the $10 million valuation, not the amount that was actually contributed. They then pass the value of this inflated amount onto the taxpayer who made the donations. Now, if you look up this case on the Department of Justice website, it says that the CPA had been promoting this strategy since as early as 2008. That's more than 14 years. That means hundreds of people told someone how they had been doing this for years and had never been questioned about it by the IRS. And then, boom, one day the IRS shows up, disallows years of massive deductions, and charges interest and penalties, which wiped out net worths. I told the client about this specific case, sent him the link, and told him to make sure he reads it clearly and carefully before considering this strategy any further. He said he thought it sounded too good to be true, but he's not worried because his next strategy was the favorite he had been pitched. Before I go on with the new strategy, you need to know this client was a sophisticated guy. During our conversation, he demonstrated that he had in-depth knowledge of very in-the-weeds tax topics like excessive business losses and material participation. But when you're staring down the barrel of a massive tax bill, even the smartest people can be sold a dream of hope and tax reduction. So the second strategy was something called arcade leasing. This title sounds so exciting, I could probably get my 9-year-old nephew to listen to me talk about it. Here it is. You put up $25,000 to purchase an arcade game and the maintenance of said arcade game. The total cost of the game and the maintenance is $200,000, but you only have to put $25,000 down. The remaining $175,000 you pay for with a loan from the same people you give the $25,000 to. However, you don't actually have to repay the loan because the arcade game will be generating enough money to repay the loan for you. And if there's leftover money after you pay the loan, you get a monthly check for that amount. But here's the best part. You get to use bonus depreciation to take a $200,000 loss in 2026, which will offset your $500,000 in income. I told him even if that was true, he would probably not meet the at-risk for loan test by the IRS. The IRS says if you are not truly at risk for a loan, then you cannot take a loss for more than you are at risk for. In this case, that would be the $25,000. Now, even if he was at risk for the loan, he would have to meet one of the material participation tests so that the $200,000 loss could be used to offset his income. Meeting a material participation test basically means that you have to show up and do actual work on the arcade game. The client understood material participation and told me that He was going to live within driving distance of the arcade game, and he was ready to show up and do work. I asked what exactly he would be doing to this arcade game, and he said, whatever's needed. Clearly, the promoter of this strategy had covered this in his presentation. I said, okay, let's put technical tax stuff aside for a minute. And I asked him, have you done research on the promoter of this strategy? Does he have some good reviews online? He immediately Googled the promoter and began reading from the first thing he saw, a federal restraining order. It said something to the effect of so-and-so has been banned from promoting abusive tax schemes. I dropped the proverbial mic. I felt like a superhero who flew down to save an old lady before a bus driven by a villain was about to hit her. I tried to remove all signs of gloating from my voice before saying something like, I think we can take that option off the table. 4 main takeaways here. Number 1, just because the tax strategy is being pitched to you by a CPA or lawyer does not mean it's legit. Number 2, just because your cousin, your neighbor, and your best friend have been getting away with this for years does not mean it's legit. Number 3, if the tax deduction sounds too good to be true, it probably is. And number 4, before you invest in anything or give anyone a significant amount of money, please do some internet research, at least Google the person. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.